You're watching SBA Today. With all the latest news, stories, and advice, here are your hosts, Paul Long and Tonya Mazurek.
And welcome to SBA Today, sponsored by SBA Collective for the week of June 9th. I am Paul Long.
And I'm Tonya Mazurek. And today we are going to talk about ... AI
Ooh.
first.
That's true. Now, this is really important because we talked about AI last week, and which, by the way, a lot of you reached out to get my code, which I'll totally give out free. Just shoot me a message on LinkedIn. I enjoy talking with our listeners, and it's super nice. So, and it helps everybody. So, but again, I want to reiterate that AI, you really need to check. You need to check yourself, right? So I want to share with you the power of AI and how you really need to be careful. And hopefully many of you are watching on YouTube to watch this. So Madison, go ahead and show our first image. So here is Tonya Mazurek.
What the heck? You didn't show me this.
And it's very professional photo, right? AI, pretty impressive. I don't know. Maybe you should send this to City and Trust Bank and see if they're hiring. But hey, I thought that was pretty good. AI. So okay, AI did well. Let's go ahead and go to the next one.
Yeah, look at that.
And then the next one, we get a little more creative. So we have Tonya checking out with a banana at the store. We have her working on a crafting project. We have Tonya golfing with a toaster. If that doesn't tell you a lot about AI, I'm not sure what does. And Tonya eating soup with a fork, a massive fork. So you can tell that AI does a pretty good job of it does what I ask it to do, but it's got its little quirks. And finally, next one.
Oh Lord.
We have Tonya's wedding photo of her of a stud that I found on AI. So and it's and so there we go. So again, the power of AI.
I apologize for Paul. Right? Whoever this person is that's walking me down the aisle.
Right. Yeah. So, hey, again, it's the power of AI. So I'm pretty impressed with that. Now, I will say that I don't know why, and this just came to my head, but if you put back that picture, Madison.
Oh, you can totally take down that picture, Madison.
Doesn't that person in the background who's clapping look like somebody?
Whom?
If you're in the SBA industry, you know Chris Hearn. It kind of looks like Chris Hearn. I just noticed that. Hey, Chris, apparently you're at Tonya's wedding. So
apparently you're at the wedding. I didn't know I had.
Didn't know you had. Exactly.
Did I enjoy it? Was it a good one?
I don't know, but you got a stud. Anyway, again, it's the power of AI. Watch on YouTube, and if you're listening to audio, none of this makes sense. So, Tonya, let's go into the 10 million.
What it does make sense is that means you got to come watch this stuff because he loves to do this to me. All I saw on our notes is update on AI. That's what Paul sends me. So I thought he was going to talk all about his AI stuff.
Why should I tell you about things I got cooking?
Just wait, buddy. Just you wait. Anyway. All right. So reminder, guys, the 10 million combined 7A and 504 limit takes effect July 4th. Originally, it was announced on May 18th, 2026. So just a couple of weeks ago. Anyway, while not brand new this week, lenders are actively preparing for the July 4th effective date, and the SBA leadership continues to highlight it across the freaking board, as y'all have seen out there on everybody's post. Anyway, what really changed? Borrowers may now combine up to 5 million 7A loan, as well as 5 million 504 loan. We've got more around that, but highest cumulative SBA financing limit in agency history. They really wanted y'all to know that. And why it's trending this week, lenders finalizing deal structures and borrower outreach, particularly impactful. for manufacturing, logistics, and owner-occupied CRE. And now, Paul, let's talk about
Well, so we were just kind of chatting about this before we jumped on air.
We were.
I think what you're going to start seeing is, again, more people maximizing the 504, which is great for the customer. Absolutely great program. And then you're going to see just the airball deals of a business acquisition on the 7A. And I just think this is a great, in my opinion, it's actually a phenomenal way to eventually maybe get to the 10 million 7A. This is the best hybrid approach that you can go on this. And keep in mind, there's no new rules. It's not like this went through the House and the Senate and was blessed. It's understanding your rules, right? And just making it clear. So I think it's great. I think we're going to help more people. I'd love to see, though, when this comes out on July 4th, what some of the transactions and if we see an uptick in transactions during that time.
Well, and then the transactions, but again, I still say, I hear what they're doing. I get the cumulative. Okay, fine. There's more. It helps a little bit more with risk, but there's still freaking risk in all of these deals, guys. And it's still a freaking credit department that needs to want to extend that much credit to one borrower. And I think that's what I'm waiting to see is how it affects. Do you know what I mean? How it affects others. Anyway.
True. And time will tell.
Okay, these two are freaking texting behind the scene on chat, y'all, about the freaking picture Paul puts up if it's my type. All right, you two, knock it off. This is my producer and Paul. They're messing with me on the back end, just so you know what happens with these two.
It's her type.
Anyway, keep going.
Anyway. So in this week's episode, we are going to talk more about equity injections. I know. If you're not in the SBA industry and you just heard us say our topic, I mean, you're at the edge of your seat, right? But we want to talk about equity injection myths that kill SBA deals.
Right.
So, myth number 1, seller financing counts as equity. Okay. Well, the reality is seller notes do not fully count as equity only when it's on standby. Either it's on interest only and you've achieved the 10% mark. And, the SBA still really wants to make sure that you have skin in the game, right? We want to make sure that you as a borrower are injecting the capital and that we're not just shifting risk. Because if you put in no money, and this is the Paul Long credit philosophy, and that is if you put in no money and the business goes south, what's in it for you when we're the one taking 90% of the risk? Like, that's not fair.
Wow. And there's a few things, and I know how borrowers think about this. I had a conversation with a borrower actually in the last couple of days regarding, or a business owner, let's say. And this isn't on our notes, but I think one of the myths in there has to do with the borrower seems to think that because there's an SBA guarantee that's backing the bank, that means it's either the SBA's money, right? It's the SBA's money that's being lent out. It's not. It's our credit. It's the bank's money, and they don't get it.
My money.
And so exactly. So they think, well, if we've got all these different things, why do I have to have my money in? And the big thing to you borrowers, it's because we want to know the skin in the game, right? Because seller notes can strengthen a deal. They don't exactly replace at all the borrower having skin in the game. So that's kind of the big thing on that one.
Preach it, sister. That was perfect.
All right. Anyway.
What's myth 2?
Myth 2. I can borrow my equity injection. Of course I can.
Yes.
Reality. Borrowed funds equal debt, not equity. Okay. And there's a few different things around this. Common red flags when it comes to this is personal loans. All right. And we'll talk about the personal ones. HELOCs that are not disclosed. And now something around the HELOCs that a HELOC can work, right? If you're paying that debt on the outside. So let's say you've got a business that you're using a HELOC on, but you have outside source of income, and or let's say you've got a spouse or something like that that has an outside source of income that is paying the payments on that HELOC, then that would be acceptable. If it's a HELOC, it goes in, everything is under the business, there's no outside source of income, it does not work because it's debt the business is having to pay back. So just want people to get clear with that. Anyway, so anyway, a HELOC isn't automatically disqualifying, and it's how it's properly disclosed. We don't want to know about it later. We want to know about it up front so we can make sure, like we've just said, what it looks like and what the structure is. Okay, credit card cash advances. Now, I wonder
who
why
the beep would do that. Good Lord.
And why would you think that's acceptable? Again, I mean, no. Let's double pay some stuff. No, I'm kidding. Okay, family loans without gift letters.
And without statements that go with the gift letter. The SOP is extremely. Yep.
Yes.
Show me the money.
Show me the money. And the reason, like he said, it kills it. Funds that look like cash doesn't really mean they are cash. Source of funds review exposes debt. That's what the SBA is looking for. They're looking, or we're looking for, actually. We're looking for the let's say the statements. If you've got money that's coming in, you got $10,000 that was just transferred into your bank. We're going to want to see where it came from and the last couple months of your statements to make sure either the money that's in there is seasoned, so it's been there for a while. But if it's new, we're double checking where that came from because we want to make sure that you're not getting money from somewhere that you're not supposed to be. So anyway, regardless, if you have to pay it back, SBA does not call it equity.
And if you, and from a credit risk standpoint, every time I see that, I immediately cringe because you better have one rich spouse or you have a secondary income that's just Amazon or something. Because it's just, yeah. Ooh.
Yeah.
With number 3,
interesting.
Well, sweat equity should count. Reality, SBA doesn't care. SBA does not recognize sweat equity. That's called doing your job. I have sweat equity in what I do every day with my employer. That does not mean I own part of the credit union. Okay. I know, I don't feel like it. Time, experience, or effort does not equal a capital, right? There is an exception. Yeah, we like it. We require it, but that's just a gold star. Good job. Only in very limited circumstances can that documented seller equity roll over in partial changes of ownership. So again, it's often misunderstood, over-implied, but make sure you check out that section of the SOP on that. What about myth 4?
Oh, let me get back here because I'm going back and forth, as you know, with my silly little stuff. Okay, myth 4, as long as the lender is okay with it, SBA will be too. Now, I love this one because this can go both directions, right? Okay, reality. SBA guarantee review is independent. It's independent of the credit department of the bank. Separate. Anyway, post-closing repairs or denials are real. Lenders must defend equity structure.
Post-closing repairs and denials are real to the lender. Right?
Right. And that's, I think, what people get so confused on sometimes, like we talked about, Paul, right? Where they think just because the SBA is guaranteeing it, and everything is fine. It's not. If a bank does a lot of bad loans, we know this, right? If a bank does a lot of bad loans, they go bad. They lose their license to do or lose their ability to continue doing SBA loans. 2, it hurts the industry, and anybody that's doing, as we've seen recently, things that don't work with the SBA, it's going to hurt everybody because rules tighten. The squeeze. Anyway, documentation matters more than intent. So.
Amen.
Amen.
So, our Tonya, do our next section here.
Sure. All right, guys. Sorry, I'm having an issue with my throat this morning. Acceptable equity sources clearly distinguish good equity from problem equity. Okay. And we want to know this up front. Typically acceptable is personal savings that are seasoned, like we talk about. It's been in your account for a while. We can go back through your bank statements. We've seen it sitting in there for at least 2 months prior to the statement of, or the time.
I like to just sprinkle salt and pepper on my equity injection, and then therefore it's seasoned.
Oh no, you gotta have some Tonys on it. That's even better. Mo better. Anyway, verified asset sale proceeds. Makes sense, right? Cash gifts from immediate family. Proper gift letter, evidence donor has capacity. A couple things with that. Now, why in the heck does this say just immediate family? Because honestly,
it's true.
Well, honestly, you can have a gift letter, you can get money from whatever, as long as it's acceptable. We're gonna check it though. We're gonna check it. So they're gonna have to also show their statements that it's not borrowed. I've seen that. Sorry, I've seen that before. Things are. Yeah. Anyway. Okay.
When I see gifts from friends, my hair on the back of my neck goes straight up, because that is we'll call it a silent investor. And all of a sudden it just family member, mom, dad, kid, grandma, whatever, I'll buy. But when it comes to, they're a friend. Yeah, sure. I have tons of friends that'll gift me money. Tell me?
Yes. And a few things with that. Do we really know? No. That's why we get concerned in general with gift letters in general. When it comes from, a parent or something like that, oftentimes they're going to give you that money at some point anyway. So that makes sense to us. But like Paul said, if it comes from a friend or I just like you, you're such a good person, I'm going to give you $100,000. You don't need to pay it back. I mean,
Tonya does that. Feel free to reach out to her on LinkedIn. Like she'll give you any money you want.
Yeah.
Gift letter.
I will. Okay. Yeah, there you go. I want that for you. No, I'm kidding. All right. So common problems or seller carry on full standby as a supplement, not replacement. What we mean by that is they will see it as part of the equity injection. There's 10% equity injection that you got to have into change of ownership deals, let's say, right?
Yep.
5% has to come from the borrower themselves. Is it? It's still 5%. 5% has to come from the borrower itself. It went down to 2.5%. I remember that for a minute. But anyway, the seller the reason it can work as long as it's. I can't even get my words out.
The other 5% needs to be on full standby.
Paid back. Exactly. So, but I don't know why it says as a supplement, not replacement. I mean, that was some of our notes. And I think what that means is, think about it, Paul.
What it means is read the dang SOP and assure you have 5% in, and 5% can be on a seller note on standby.
Yeah. Anyway, we'll just keep it at that. Common problems: undocumented cash, loans disguised as gifts, which we just talked about, right? Side agreements.
I've never seen a side agreement in my entire career. Said no lender ever.
The point is, we don't see them
until it shows up on their annual review on a balance sheet. And you're like, what's that? Right. Oh, well, that's this. And the lender does, I got stories. I got stories on that.
Oh, dude. That'd be a fun one to talk about. Okay, last minute transfers with no paper trail. Again, we need to know where that money came from. It can't come from somebody else. It's debt from them. They got a HELOC to give you money, blah, blah, blah. We've got to double check where that money came from because, anyway, it can come from all kinds of places.
Trust but verify.
Trust but verify. Equity isn't just money, it's documentation. That is so
true.
Anyway.
So, how borrowers can get equity right the first time. Here's an idea. Plan. Save money. Be prepared. And make sure you have that before any sort of LOI is signed. Don't just sign an LOI and be like, okay, now where am I going to get this money? Which I've seen people do. And I'm like, tweaking in the back. It just doesn't make any sense. Discuss source of funds early with the lender. Hey, guess what, lender? You're probably going to have that before they even want to discuss it. A good lender should be all over it. So where's your down payment coming from? Because looking at your personal financial statement, you have
Doesn't look like
$2 in your checking account.
What? Oh, it's coming in. Serious.
This one I really do agree. Don't move money without guidance.
Oh my God, don't do anything without freaking guidance.
Let the lender tell you, okay, it is now time for you to put in your working capital. It is now time for you to do this because we're making sure that crossing our T's and dotting our I's. And then finally, assuming everything will be verified because it will be.
Yeah.
Right. I know I've seen, oh man, maybe we should spend an episode on this because there is a lot of different bombs that I've seen.
Cash-based businesses, the cash-based businesses. Think about this and what they do with that cash. Oftentimes, it can't come from underneath your mattress, people. It just can't. Yes, maybe you made it. Maybe you put it under your mattress. We don't know that, do we? And there's no way to verify that. Have you seen that, Paul, or have you had? I'm sure you have, right?
I have had somebody take a picture of their money inside of a safe and say, here's my equity injection.
Oh my God.
And they were true. They're like, yeah, here it is. You're joking, right? Like, what? No.
But you know what's funny about that, Paul? There are many people that really have, which is hilarious. They have no trust in the banks, and yet they're coming for a loan, but they have no trust in the banks, so they don't keep their money in the bank. I mean,
anyway,
if
you're coming to me for money from a bank, but whatever. Whatever, doomsdayer.
Exactly. Oh my God. All right. So most equity problems aren't about money. They're about assumptions. And the earlier you align expectations with your borrower and with your lender, the two together, right? The faster and cleaner the SBA process becomes. I think the whole thing about this, Paul, right, is the conversation up front, not after, right?
Yep.
Don't move things without talking to your lender because you might think that it's perfectly fine. I've had that happen before. And they go and get a HELOC or they go and do this. And it's like, we were using that as collateral. And then they go and get money. They go and get money and then they take that. Oh my God. Right. Well, I didn't know. Or they do something because they don't think it's going to affect. Well, assume everything is going to affect it.
Yep.
That's the assumption that we need to make here. Anyway.
Preach it.
All right. Yeah. All right. Don't forget, we're live on Tuesday mornings right here on LinkedIn and YouTube. So come join us. Otherwise, go check it out on any of the platforms where you get your podcast because we'll be there. Check out our past episodes as well and connect with Paul or I. So Paul T. Long and or Tonya Mazurek on our LinkedIn pages. We would love to chat with you. If you like what we do, share and let us know. Just give us a thumbs up because we love to hear it and know that.
And if you don't, why are you listening?
Well, no, if you don't, also reach out and tell us how we can
reach out. Okay, fine.
Who can tell, right? All right. We recognize you guys have plenty that you could be doing right now with your time. Thank you for spending it with us, and we will see you next week.
See you later.
Yeah, see ya.